Ho, ho, homes.
Did you plan that?
I did. I've been
Ho,
thinking
ho,
about that all
homes.
morning. Merry Christmas. Happy holidays. Happy New Year. This is the
It's a year end.
holiday special real estate show podcast. Anthony Butera team, Jason Mancuso here, as always, and joined today by Santa Claus himself.
Yeah.
Anthony Butera.
Big Santa.
Gonna recap 2023, do a preview of 2024. Real estate market relative to Rochester, New York, talk about, some national stuff, but I don't know, I guess the more things change, the more they stay the same.
Yeah, for the most part. We're not in jail yet. All these lawsuits, we haven't I expect to be in prison. But not for the lawsuit. There's other reasons. Yeah, for other things unrelated. No, so it's I can't believe that we're wrapping up the year.
Lies.
Yeah, I mean, like I feel like August was a few weeks ago.
Feels
Here
like
we are.
2017 when we first started doing this on a desk
Yeah.
with Mark.
Yeah.
So here we are.
Here we are.
Real estate market 2023. I mean, interest rates being the hot button topic, right?
Yep.
We just came off the peak of 8%. It hit 8% for a little bit,
Yeah.
and then came down. Last year was 2022, starting in the spring, was the rise of rates, going from bottom lows, for historically speaking, quickly rising to 4 to 5 to 6 to 7%.
Yeah.
We've been, so what am I going to say, about 6.5 up to that peak of 8 throughout the year of 2023.
That's fair.
So higher rates, especially compared to 2021, 2020, when things were essentially stimulated to get them down.
Yeah.
Demand didn't fall off a cliff like one may think if you're just reading that on paper and assuming what happens to the demand as the borrowing cost of money, mortgage payments get more expensive.
Yeah, I mean, one of the biggest, one of the big indicators that we don't have, because there's really no data compiling, is I think where we felt, our team lists more homes than anybody. So I think that, we have that data, at least anecdotally, with what we're feeling. I think the measurement is number of offers per listing. So if 2023, if there were a change, wasn't so much like it wasn't a change like we predicted of the median sales price being stagnant or likely receding.
Yeah.
It was just we didn't see many 10 plus offers, right? Saw a lot of 2 and 3, and that's what we're seeing today.
Yeah. I mean, we're still in a seller's market,
no doubt,
to just define overall market conditions. And again, with the rates, directly affecting demand, or at least you would think, and it did, right? Like, the craziness of 2020, 2021, like, that receded, certainly, but still in a seller's market, still not enough inventory to supply the buyer side of it, the demand side of it.
You consumers are confident.
Yeah. And I mean, which is good.
Yeah.
Right. So I think there's, log jam rental wise too.
Yep.
Rent prices are high, generally speaking. People, obviously would rather own their home than be renting. And, most situations where the life logistics call for it, I guess is how I'll phrase that. So just, and speaking to Rochester, New York and the surrounding area, super affordable price point overall. We're still, even with the growth that we've seen in the last, call it 5 years, we're still, couple $100,000 below the national average.
I think sometimes we lose sight of that too, right? I feel like I'm in conversations frequently because you and I are in conversations, whether it's our business coach or with agents across the country through masterminding, right? Like, when you tell these people that don't live in upstate New York that you can get a single family home in the suburbs with a good school district for $200,000, their minds are blown.
Mhm.
When you say $200,000, that's not a house for them. That's a down payment.
Yeah, it's true.
We
It's
lose
true.
we lose sight of that. So affordability is high. And we think about like, why is our market still always on these news articles around being the hottest markets? Because our income is not far off of what these areas that have median sales prices of 600,000. Our incomes are pretty much the same. Affordability is way different, right?
Yeah, for sure. And when you break it down in the national picture,
Yeah.
one, like 2023 will end up being, historically speaking, I'm trying to think, but certainly in the last decade, plus the fewest number of homes sold nationally.
Yeah.
So, as far as a market crash, the only thing that crashed was the number of transactions.
Yep.
So, the consumer out there that's either waiting for the market crash to bring pricing down, or, hopefully looking at it to where they're reaping the benefit of everything that's going on. Your value just keeps going up.
Mm-hmm.
And that's, local to Rochester, that's happened again in 2023. We've had an increase in value. Nationally, to comment quickly, it's not the same story everywhere. There's been a lot of markets that have had pain this year. Austin, Texas being the number one spot there, to where they had a big tech boom. They had, the real estate boom followed that, as was going on with the rest of the country too, leading up to 2022. And they decreased, at a good clip this year.
Yep.
So there's some pain in other markets, but not here.
It's going to be interesting, because if we could fast forward 30 years and we're real estate agents, God, I hope we're not still real estate agents. But we can look back and reflect. Well, I guess 30 years, because we'll have amnesia around the market conditions we're in right now. And we're going to be able to look back and be like, oh, wait a second. Look at the drop in number of units in 2023. Oh, wait a second. That makes sense. The interest rates went up.
Yeah.
But we're an anomaly based on market trends, historically speaking, because at that time, everyone's going to assume that it was because the buyers weren't willing to buy because there was a spike in the interest rates. And that's just not the case. Sellers weren't willing to sell because of the interest rates.
Well, and it's funny the way you say that, in terms of, looking at charts, right? And looking at the number of homes selling total dropping significantly in the last 2 years compared to, also keep in mind, we were at a peak in 2021. So going to seem like dropping off a cliff on that chart the last 2 years. Pricing, not skyrocketing, but still inching up.
Yep.
And you would think that doesn't make sense, right? In correlation, I should have said first, like the rates skyrocketing, home sales dropping, but pricing still going up. That doesn't add up.
Doesn't.
Right. So it's the other consistent hot button topic of the market of late in the last 3, 4, 5 years is inventory.
Yeah.
And that's ultimately it. There's just, I said it before, it's not enough supply to feed the demand.
Yep.
Really no cure or end in sight to that either.
No, we talked this morning, right? Because we're always paying attention to where we think the interest rates are going to be. And you saw this morning, and you're always really good about following what's happening with the feds, right? And jobs reports came out, and
so I mean, the 8% peak that we talked about happened in early November.
Yeah.
Late October, early November. And that was kind of like, ooh, not good. But still, demand didn't stop. Don't get me wrong. I'm not saying there's not effects. Okay. It certainly causes people to bow out or sit on the sidelines longer. But people, we're not going on sabbatical here, right? People are still, have a need to move. People are, recognizing the opportunity and taking advantage of concepts like, okay, let's buy now without, competition and having to go $100,000 over asking price. And knowing that, okay, it's unlikely that the rate's going to go to 15% or anything crazy. And if it does, well, you're in at 8.
Yeah.
But when it does drop, banks have gotten creative, lenders have gotten creative to offer products like, buy now. And then, when you do refi to 5 or 6%, when the time is right, we'll do that for you for free.
Yeah.
And stuff like that going on. So in the last 45 days or so, we've seen a significant drop in interest rates from that peak of 8 to, 7, even below it.
Yep.
Recently this week.
6.85.
Yeah. So looking at the chart, there is a steep drop, which, hindsight's always 20/20, but you have to know that that's just not sustainable in terms of to continue at the pace it's been on in the last month.
Correct.
And have to know that it's not sustainable because ultimately these things fluctuate. Now, not to get too deep in the economic weeds, but essentially, if you want rates to be lower, then you need economic pain.
Yeah.
When, the economy is crushing it, then, that's been reason for them to increase rates, ultimately to cure inflation, which, to comment on quickly, has been, coming down this year, still not where the Fed wants it. But fast forward to today, this is being taped Friday, December 8th. Jobs report and unemployment report is a key indicator for the economy, of course. And they had, the way this works is they have a prediction and they set the prediction, and the report came out much higher than expected, and unemployment dropped, indicating still a strong, booming economy out there.
Yep.
So you can expect, and it gets dangerous to make predictions, but you can expect these rates to go up a little bit here in today, frankly, and in the following week or so. But that's just the fluctuation. Overall, the prediction for next year and the year ahead, and 2025 even, is that they're gonna start sliding gradually.
Yeah.
Not, again, the 8 to 6.75 around that range.
Yep.
1.5 in a month is not the pace that you should be expecting.
No.
I mean, a lot of predictions are that we're at 6.5 this time next year.
Mm-hmm.
Which
I think that's healthy.
No, exactly. And I think ultimately get in that low 6 range, high 5 range, be happy. Don't get any greedier than that. Understand that the 3%, high 2% that we experienced is a total anomaly, and you can't just expect that that's going to happen. And it'll continue to fluctuate because there's all sorts of economic data. Ultimately, inflation is the key thing here. And if that keeps coming, down more in check to where they want at that 2% level, that's a good case for rates to not have to go up any further, certainly. And I guess, again, dangerous prediction and optimistic prediction, right? Hopefully optimistic here with what I say, that, that 8% threshold being the peak.
Yeah.
Because of how things are shaping up overall economy wise, hopefully we've reached that peak, and it's just kind of the fluctuations that happen on our, downward trend back to a 6% level, I guess is, where you would want to be if you're planning on, if you're thinking you want to buy a home in 2024, and you're saying the only way I'm going to buy a home is that if the interest rate's 5 or lower, you're probably not buying a home.
Well, and to that, you can't give me an example of a buyer that has put themselves in a better position by waiting. And we're going back 10 years. There's been a decade where by waiting, no matter what the interest rate was, it ends up costing you in the end, right? The buyer that didn't buy when the rates were 3%, right? And they were waiting. Well, guess what? You assumed that the values were going to flatline, and I was assuming the same thing. And what's happened while waiting? Yeah, the rates have gone up, but the values have gone up even more and even faster. And listen, with what's been happening and still the urgency and the confidence with the consumers is we're going to be sitting here next year and we're going to be talking about how much the median sales price has gone up again. And when those rates trickle down, and let's say they drop into the sixes in the second half of 2024, the floodgates are going to open again. So while you're waiting for a rate that you think that you need psychologically, you're paying more in the end because you're having to pay more in the end for a home that's going to spike your interest.
And this to me all comes back to inventory.
Yeah.
This would be a totally different conversation if, I don't know, China comes to mind, right?
Yep.
Where they have all these like ghost cities now that
Yeah.
like literally cities just planned for and built.
Yep.
And they're sitting vacant now,
Mhm.
right? Like if we had that problem here,
Yeah.
totally different conversation. A, we don't have it in America, period.
Yep.
B, we certainly don't have it in Rochester, New York.
Yeah.
There's only so many homes to live in, period. And then there's only so many few homes being built new to help the supply.
Yeah. And
So-
modern medicine hasn't helped us at all. People are living way they are.
I mean, I laugh, but that's a great point.
It's true. These boomers aren't going anywhere. They're
And
fighting.
They're creating a log jam too because they're in their colonials that they raise their family in. They want to get into their ranch. They're not available. There's not enough
Yeah.
townhome developments or whatever.
Yeah.
And
30 years ago, the only log jam was in their diapers. But now,
our generation wants those homes.
yeah.
They're not going up for sale. If you watched our recap last year, it's probably a similar conversation.
Yeah.
I'd be willing to bet it's a similar conversation next year too.
They people, people that have owned their homes for a while, right? Especially if they still have a mortgage on it or whether they don't, like they're digging their heels in.
Well, and that's ultimately going to continue to fuel the
Yeah.
supply problem
Mhm.
is because everybody that did buy prior to late 21, early 22, now which was a lot of sales, right?
Mhm.
Because it talked about 21, 20, 19. That was the upward trajectory of, the number of homes selling,
Yeah.
reaching record highs.
Yeah.
So a ton of people bought, a ton of people are locked in to sub, what is market rate today.
Yeah.
And significantly under the market rate.
Yeah.
Because when we're talking 3% interest rate and you're locked in for a 30-year mortgage and you're in a house that's good enough,
Yeah.
why am I going to pay a higher price, a higher rate, a higher monthly payment?
Yeah.
Sure, your home probably sells for, like you've appreciated, which is good too,
Mhm.
but not enough to plop down an extra. I mean, it's dangerous to throw out numbers, but the $150,000, $200,000 home buyer, it's not appreciating where that home is now worth,
Yeah.
$350,000 in the last 2 years. So you're safe, your assets, your investment's protected, but not enough to offset the higher costs. That's ultimately creating this logjam too.
And like the state of the economy, anybody that's owned a home for the last 5 years has seen more wealth than ever before.
Yeah.
By not doing anything. It's just the market conditions, right? And those same people whose homes that have increased drastically in value are also gainfully employed at that same time. We don't have unemployment. I mean, let's face it, it's non-existent. If you're willing to work, there's 1,000 opportunities for you, right? So that plays into it too. And then I was talking to a few agents yesterday and a lot of these conversations, they start to get political and I got to start checking out, but they're like, there's going to be a ton of inventory. Everybody's leaving this stupid state. And it's like, here we go. Really? Yeah, people are leaving. And for every person that leaves, there's 5 more that want their house.
Yeah, it's not that that's not true, but the math doesn't match.
Yeah.
Where it's gonna, change the environment.
Yeah.
Buying and selling property. So, I mean, to wrap up 23, again, less competition, but still competition.
Yep. Still competition.
Haven't evolved, to get specific, we haven't evolved out of just the majority of offers being able to have a home inspection.
Yeah.
Or to be under asking price or anything like that.
Mhm.
It's just a matter of you still have to make a strong offer. You still have to be competitive. You're just going against, 3 to 5 people instead of 30 to 50.
Yeah.
Which was the environment in 21. So inherently your odds increase as a buyer, but don't take that as like, okay, I can just come in guns a-blazing and, my dad told me to always offer 10% below asking to start the conversation, like he did back in 1985.
Yeah.
And expect that it's going to work.
Yeah. Your dad still smokes a pipe, Charlie.
Nothing wrong with that.
No.
So trying to think of anything else. 23. I mean, home values inched up.
Yeah.
Rates reached their peak, hopefully.
I think that's a ceiling. I think,
Well, yeah, all of this whole show, right? Or at least looking ahead anyway, making these predictions, the asterisk is like assuming nothing drastic changes, and that's a big if these days.
yeah, but what's drastic that could change it, right? COVID was supposed to be drastic. Look what it did.
Well, but it had an effect,
Yeah.
right, and led to the low rates.
Yep.
I'm talking, World War type stuff,
Gotcha.
right, or another, pandemic or whatever.
Yeah.
So that level of drastic, because we've also seen, drastic stuff happen, late this year with the unfortunate, the situation in Israel and Gaza and stuff like that, hasn't totally turned the market into turmoil.
Yeah.
Hopefully that is the peak.
Yeah.
But to summarize 23, we reached the peak on a very big factor of interest rates, and more or less business as usual. Now, I said significant amount of homes, or significantly less homes selling. So to just speak to our industry of real estate, on the realtor front, arrogantly speaking, we're good, but we did great. But there's a lot of agents that are in a lot of pain. Then a lot of them are getting out of the business. There's also slightly more getting in.
Yeah.
So it's kind of funny there.
The median salary for agents nationwide is $30,000.
Yeah.
Right. It's the top 5% of the agents are selling 95% of the inventory. That's just, it's a reality in any industry. So like the thought that everybody's been killing it, it's just not there. And for us personally to talk about our team, right? Like 2021, we couldn't miss, right? Prices were skyrocketing. Rates were still low. Everybody buying, everybody was happy. Sellers were okay walking away from their 3.5% interest rate to maybe a 4 or 4.5. And it changed, but it didn't produce the amount of changes that we thought. We were talking about stabilization. We were talking about maybe even pivoting over to a buyer's market. We were planning for that, right? But 2022 came to us and said, I hope you enjoyed 2021. As a team, our production dropped off dramatically in 22, like the industries did.
Mm-hmm.
And now this year, 95% of agents' business went down from a units perspective, which is the only measurable I care about. And we found a way to learn from 2021, pivot, and we're going to sell more homes in 23 than 22. And that is not the case for
we're back to 21 levels, which is great. Not to get too personal, but I mean, for the agent and the consumer in 21 or leading up to that, it was just, there was plenty of reason to buy, plenty of reason to sell. Therefore that, just creates kind of a more, easy way of the business for agents, right? 22 happened, wake up call. We took our medicine and really got back to basics. Really got back. That's a tough conversation to have with consumers that aren't, I mean, for everybody, right? Even if you're familiar, there's questions. So, really got back to us doing what we do best. And truly, just making sure that we have your best interests in mind and protecting them. Not that we got away from that in the boom year, so to speak. But it was just like, of course your best interests are, man. You want to buy this house, you need to move, and the rate's that low. Now it's like we got to really dive into the details with you and make sure that you're making a good decision.
Yeah.
And make sure that you're ready to go out and reach those goals.
Yep.
And a lot of agents in the industry, and don't mean to disparage our industry, but they're just not equipped for that.
Yeah.
And a lot of agents got in during the boom, and it was easy.
So
Easier.
easy.
And now they're deer in headlights type of stuff.
Yeah.
So the turnover is there. It's still an industry where there's plenty of people getting into it. So they're going to cut their teeth the right way.
100%. And listen, it stinks for them right now. But if you got licensed in the last 5-6 years, you had no adversity from the market conditions
up until now.
So when the adversity comes, they don't know how to react to it, because it's always been good news.
Yeah.
And there was always great data. But
we were in that boat too, just being in it for a little over 10 years together, because, we didn't get into it before 2007.
Yep.
So didn't know what that looked like. So, early part of the decade of the 20 teens, whatever you call it, it was just a gradual climb.
Yeah.
In a buyer's market to start, then shifting to a seller's market, and then rocket ship takes off.
Yeah. Our personalities, and our work ethic is what got us to where we were. And it also created our ceiling. It wasn't until we changed the consumer experience and increased our value proposition and brought more people into that. Right. And now, again, cool fact, which we're an anomaly as a team, which talks to the customer service that we're giving. Once again, we sold more listings than we did even work with buyers. And what that means is the buyers that we worked with the past few years now are referring us, and they're selling their homes, and they're using us, right? So we have it's a healthy, mature business. And you don't learn, listen, through fruitful times, you don't learn much.
Right.
You don't have to. And your ego keeps telling you that this success derives from the things that you're doing. And then when the market slaps you, you're like, holy shit, we were idiots.
Well, vulnerable enough to admit that,
Yeah.
right? Those that, don't have that conversation with themselves in the mirror and don't cause any change. Yeah. It's going to be tough as an agent, right?
Yeah.
But there's, look at what I've related to a lot lately is, the analogy of if you're representing somebody, if we're representing you as a buyer or a seller, it's going to seem like you're lost in the woods. We're there with you, lost.
Yeah.
But we have the map to get out. So we can show you step by step how to do it. Yeah. And we'll also be the first to challenge in terms of not questioning your decision making or what you want in life, right? But just making sure that this all makes sense.
Yeah.
Because of what you have to do, what it's like, what the rates are, et cetera, what prices are.
Yep.
So it's a good, healthy dynamic that we have in our business and how we treat and represent our people. As a consumer, make sure that you're confident you have that with the person you're working with.
It's so cliche and it's said so often, but it's so true. People don't care how much you know until they know how much you care. They never remember the transaction. They remember how you made them feel. Right.
Sure.
And those are the people that are going to refer you. Right. And it's interesting. I did a mastermind today with Tom and our team and Jay Sackett, and Jay said something interesting. He says, I got into this industry during really funky times. It was COVID. We were shut down. So aggressive that my clients had to write 6 offers to get an offer accepted. He says, but what's amazing is I was able to build stronger relationships with my clients by going through that with them. And whether it's your significant other or a best friend, the strongest relationships seem to derive from 2 people that have been through a lot together.
Sure.
Right. Yeah. Because if the market was what it was 10 years ago, and hey, you like that house, I got you pre-qualified today, I'll write an offer tonight, it'll get accepted tomorrow, and we close in 60 days. You haven't been through much together.
That's a good point.
So what an opportunity, right? I thought that was really cool when he said that. What an opportunity to go through something with people and be a part of their journey and then maintain and this place is haunted. Something just fell off the wall.
Real
That must have been one of our estate sales. But you know, it's cool perspective.
It,
Anyone
it really is. I love that.
Yeah.
And it's true. And it's the way the business needs to be.
Yeah.
So it's great. Like we're looking at everything, all the challenges that are ahead, all the challenges that we've experienced, just make us stronger, get us back to the way the business should be. Because again, we're not, this isn't buying shoes. This isn't buying a car. This is your home. This is where you're going to live. This is where you're going to raise your family. This is the biggest financial investment that most people make. This is the biggest part of your net worth statement over time that most people have.
With that being said, 5 years ago, our average sales price is what it would cost to buy a Chevy Tahoe.
Yeah, that's true. That's true. Which speaks to the inflation.
Yes,
right?
exactly.
So looking ahead to 2024, I think again, don't expect major change. And if anything, there may be, more extreme or more what may seem like back to the extreme conditions if/when these rates do continue to trickle down. And, if we're in the mid sixes come February, March, it's going to be pretty competitive, I would predict. So don't go into this year and, you'll see varying reports from the big players nationally. I know Redfin came out this week, fluffing that buyers are going to have the upper hand, maybe in other markets.
Yep.
Okay. But I think it's still going to be a seller's market. Do I think when I say back to extremes that it's going to be back to 50 offers and $200,000 over $100,000 over asking or anything like that? I hope not.
The consumers 3 years ago were looking for a licensed real estate salesperson that could write an offer.
Yeah.
The consumers now, given the market conditions, are going to use the best in the business. And shameless plug, it's a good thing that we are. And I think that's our real opportunity.
Yeah, it's got to be a partnership.
Yep.
And that's how we look at it, and that's what we embrace. Whether the consumer knows it or not, that's our objective, right? And we do everything we can to make sure that it is known. So expect slightly lower rates in 2024. And I'm talking probably this time next year, 6 to 6.5 is a win.
Yeah.
6 is a huge win.
Yeah. 6 is huge.
6.5 would be great to just be there and fluctuating in that, low 6,
gets in the 5s,
3/4. Yeah. Get in the 5.
Average sales price up another 10%.
Yeah. And expect, not a decline in sales price. Expect slightly more homes selling nationally overall, but not a sharp incline. So again, the way I started it, more things change, more they stay the same. It's there's really nothing in sight to cure the lack of inventory. As the rates get more palatable, get more affordable, it's just going to lead to all the demand that's sitting on the sidelines the last couple of years to get back in the game. So
business as usual.
Yeah. And again, there's a path, there's a plan, there's a roadmap. You take our hand and follow us, right? We'll allow you to meet your goals. We will make sure that, the goals are met in a manner that is at least very thought out, to where if we feel like, hey, are you sure? We're going to tell you that.
Yeah.
But, as long as everything adds up financially, as long as everything adds up logistically, meaning you, your family, whatever, need to move, want to move, and the financial side meets that, there's a way to do it.
Yeah.
Don't get deterred by everything that you hear with the headlines.
Yeah. And if it doesn't make sense for you and your family, we will not try to make sense of it.
No, because again, it's one thing to buy a pair of shoes when it doesn't make sense.
Yeah.
Or you don't need them, right? And they just look good.
Yeah. Well, you don't buy shoes, so
these are new.
Who bought them?
My wife.
Yeah.
Shout out.
Shout out.
Yeah. Anything else?
That's it.
That's good.
Happy
Good
New
stuff.
Year.
Yeah. Happy holidays, Merry
Happy
Christmas,
holidays, Merry
Happy New
Christmas,
Year.
Happy New Year.
Check us out, AnthonyButeraTeam.com. Thanks for joining the Rochester Real Estate Show.
Thanks.